This is the lesson on stocks you really need and why I love them. Now, before I start the lesson, you might be thinking, why should I listen to this random guy on YouTube? Well, here is a little bit of proof for you that I actually know what I'm talking about. Over the past 3 years, my rate of return is 136.4%. The value of my individual stock portfolio is 48,749, with £14,454, or currently just going up to £47, is my total return. The test of time will see whether I'm truly a great investor, but for now, I'm doing okay. I'm not going to waste your time. I'm going to get straight into it. So let's go. I wish that I had this information as a beginner. This would have saved me so much time, so many painful hours. So this course starts very simple, but it picks up very quickly. So keep your wits about you. Listen carefully because I will be testing you throughout this. I want to start off with, people forget that when you buy a share, you're a genuine business owner. Now, what do I mean by that? Well, the disconnect between people and buying a share is so weird. They don't understand that you are actually buying a business. You now can say, I own that business. When I see people complaining about the price of Netflix subscription going up, I'm fine with that because I know that they're making money for me, the shareholder. So let's say you buy Amazon. You now own a segment of the company that made Jeff Bezos a multi-billionaire. Now, yes, Jeff Bezos owns way more shares than you do, but you still own the same money-making machine that Jeff Bezos also owns. Now, people say, well, you don't actually really own it because you're not running the company. But do you want to? Or do you just want to be hands-off, hands-free? Because I personally would rather be hands-free and not go through the hassle of running such a difficult company, such a large-scale company. Anyway, let's have a look at Amazon. Like I said, this course starts off very basic. What is this number here? It is the price for one share. Now, the price for one share does not determine whether a stock is expensive or cheap. And we're going to go through that today. How do we know how much the entire company is worth? To find that out, you need to do a simple calculation, which is the amount of shares times the price per share. So we look at the shares outstanding for Amazon, 10.79 billion. We times that by the share price, 205.59, and we get a market cap. Important word, remember that one, market cap of 2.18 trillion. So that is how much the entire company is worth if I was to buy the entire company right now at the current share price of 205.59. If you were buying a business, what would you want to know? This is what you should think when you're buying stocks as well. You shouldn't be buying in for hype. You shouldn't be buying in for no reason other than the name is cool. If you were genuinely buying a business, you yourself, let's say you're buying a small little business, what would you want to know? I would want to know, is the business profitable? If it is profitable, how profitable is the business? Using this knowledge, you would be able to decide on a price you're willing to buy the business at. And this is called a valuation. You are valuing the company. There are two key ways of measuring the profitability of a business. There are earnings. This is the profit a company makes after all expenses and costs, including taxes, have been subtracted from its revenue. And there is free cash flow. Now, this is my preferred valuation measurement. And for this, I'm going to show you a clip from one of my previous videos where I explain what free cash flow is. So listen closely, there will be a little very easy test at the end of it and why free cash flow is so important. I'm going to speed this up because I know there's some pretty advanced investment geezers in the chat right now. Essentially, free cash flow is just the cash left over from operations minus the capital expenditures. What is cash from operations? Let's imagine you own a donut store. You sell these donuts and you bring in cash. You've got certain overheads like paying staff and paying for the building. So you subtract this from the cash you brought in. Then you have cash from operations. But what is capital expenditures? Well, capital expenditures is the cash that you reinvest in the business. So let's say you want to upgrade your donut making machine. This would class as a capital expenditure. So you're reinvesting money into the business, but that reinvestment isn't essential for the business to continue running. So to get free cash flow, we had cash from operations minus capital expenditures equals the free cash flow. But why is free cash flow so important? The free cash flow is what's left over, and this is the money that has potential to be returned to the shareholder in the form of dividends or share buybacks. Dividends is obviously good because we receive money. Share buybacks, pretty similar. Imagine you have a pie and you own 1/4 of that pie. Now a company buys back half of that pie. How much of the remaining pie do you own? You own 50% now of the remaining pie. So your shares in the company as a percentage are higher, meaning your share price should go up. Anyway, that's enough of that. I hope you understand it. I know that the investment gurus are raging right now, but realistically they should have just skipped ahead. So that's free cash flow. I hope you enjoyed that clip. We're going to go straight into the test. What is operating cash flow? A, the profit a company makes after all expenses and costs, including taxes, have been subtracted from its revenue. Or B, the cash generated from a company's regular business operations. It reflects how well a business is generating cash from its core activities, such as selling goods or services, paying suppliers, and paying wages. Now, I have no idea what you answered, but correct answer is B. Operating cash flow, or OCF as you may see it referred to as, is a key indicator of a company's ability to maintain and grow its operations. So you remembered that, or you didn't, I don't know. But the next question is, what is free cash flow? A, the cash that can be returned to the shareholder through dividends plus share buybacks. Or B, the cash from operations minus the capital expenditures. The answer is both. And the answer is both. And a side note would be, the free cash flow can also be used to pay off company debt, or it can be saved as cash to be used later. So they might use it later on capital expenditures. So they might upgrade a certain machine, or in Amazon's case, they might spend it on robots to stack the shelves for them in their warehouses. So now you understand this. This is where it gets slightly more complicated, but this is the part that you really need to understand if you want to get into buying stocks, individual stocks. The free cash flow yield percentage is the percentage of free cash flow in comparison to the price of the company. So if we have a look at MasterCard, we can see it had a free cash flow over the last year of 15.25 billion. If we divide that by the market cap, yes, remember the market cap from earlier? It is the price, the overall price of the company, the entire company, which is 525.69 billion. We get a free cash flow yield of 2.9%. Well, actually, you need to times this by 100 times 100. There we go. And you'll get a free cash flow yield of 2.9%. Now, this free cash flow yield, 2.9%, it's a valuation metric. So a valuation metric is just a number that we create using financial results and the price of the company to create a metric that we can use to value the company with. Now, what does this mean, this percentage? Well, essentially, it means that when you buy, say you were to buy the whole of MasterCard at this price point, you should expect next year to receive a free cash flow of about 2.9% in a year's time. So you put 525.69 billion into MasterCard, you buy it all, and you should get 2.9% back from the cash that you invested in a year's time. How can we use the free cash flow yield? And this is why I love stocks. So let's round up MasterCard's free cash flow yield to 3%. And let's say that MasterCard grows its free cash flow at 15% year over year, which is what it does. It genuinely grows its free cash flow at 15% year over year. An example of this would be that last year's free cash flow is $100, whereas this year's free cash flow is $115. Now, those aren't real values. Those are just values that I've made up for an example. But essentially, this graph that I've drawn, it shows it has time on the bottom and percentage yield on the side. So this 5% here, this yellow line, that is flat, or I've tried to make it flat pretty poorly. And this represents a government bond, or this represents a bond. So a bond, essentially, in short, let's say you loan your money to the government in the form of a bond, and they will pay you a fixed rate of 5%. Now, this is why savings accounts offer you something like 4% return, because what they do is you give them the money, they just lend it out to the government as a bond at 5%, they take 1%, and they give you back 4%. So you can put your money into this, and it will give you 5% every year. First year, second year, third year, fourth year, fifth year, you get 5% back on the money you receive. Now, let's have a look at stocks. Let's have a look at MasterCard and what MasterCard will do. So MasterCard has a free cash flow yield of 3%. So it starts down here at 3%. So from the first year, you start at 3%. And what happens if it grows its free cash flow at 15% year over year? Well, this is what happens. So what do we see here? The free cash flow yield, or the yield that you will get on your cash that you've invested, has increased to 3% at year 0 to 6% in 5 years. Now, do you notice anything? The free cash flow yield has doubled. It's doubled. Now, if you have a company growing free cash flow at 15% year over year, you should expect the free cash flow yield to double every 5 years. So let's see what happens when we continue going. So we're looking at 10 years now, and now we're receiving a 12%. This is a yearly return on your money. So now you're receiving 12%. So what we begin to see is that bond initially over the first 4 years was returning more than MasterCard, the stock. But when you start to hold stocks for a longer period than 4 years, if you're starting at 3% free cash flow yield, you begin to see that stocks far outperform bonds. Now, what happens if we continue this? We go 15 years. 15 years, we're looking at 24%. 24% every year back on your initial investment. And obviously, keep doing this, and it's exponential. This is why companies like MasterCard are called compounders. So after 20 years, we're looking at 48% year over year from the initial investment we made 20 years ago. For me, this just shows why stocks are the best asset to own. If you look at bonds, obviously they return that flat 5%, very safe, risk-free. But stocks have the potential to compound like this and exponentially grow your wealth over a long-term horizon. Let's say that MasterCard was trading at an expensive valuation of 2% free cash flow yield, right? So 2% free cash flow yield, let's say, starts down here, and it would double. So in that 5 years time, you'd get to 4%. And then after that, in 10 years time, you'd get to 8%. And then in 15 years time, you'd only get to 16%. So you can see the effect of buying in. If you buy in to the company when it has a lower free cash flow yield, your returns in the long term are going to be lower. You're only getting 16% at 15 years instead of that much larger 24%. And believe me, that makes a huge difference. When you see companies valued at 1% free cash flow yield, this usually means that investors think that the company is going to grow free cash flow incredibly quickly. So instead of growing it at a 15% rate, maybe the company is growing it at something like a 50% rate. So all of a sudden, let's say it does this for 50% for 5 years, you go 1.5%, and then you're looking at, within the 5 years, up to something like 7 point whatever percent. And because the growth was so much faster, investors have accounted for that by pricing it down at a 1% free cash flow yield. I hope that you've got something from that. But you may still be asking, why does the stock price go up? If we have a look at MasterCard again, do you notice anything in particular? I mean, I'm pointing it out quite clearly here with this arrow, but the free cash flow here, as it increases, the stock price increases. So here you can see the history of the free cash flow yield for MasterCard. You can see that it kind of trades around that, just under that 3%, around that 2.5% mark. Other than this large dip here that was due to COVID, you can see that it kind of trades around that 2.5% mark. So if the free cash flow yield isn't increasing like this, the price must be increasing. Because if we remember, the free cash flow yield is the free cash flow divided by the price. And we know that the free cash flow is growing. Free cash flow is growing. The price has to increase in line with it to keep the free cash flow yield at 2.9%, like it has done. And what you notice is MasterCard goes up in price as the free cash flow goes up in price. And you'll notice that it's growing. 5-year period, 15%. Don't know if you can see that, it's very small. But 15% year over year. Now I've highlighted this little red dip here, and that is because this here, this dip in price, whilst the share price, whilst the free cash flow is still extremely high, I'd consider that a buying opportunity. You can see here on this graph, the free cash flow yield increased up to 3.5%. Now, starting at 3.5% is a massive benefit in the long term. You start at 3.5%, your 5-year is going to be 7.5%. Your 10-year is going to be 15%. And your 15-year is going to be 30%. Watch some of my other videos if you haven't. This might explain a lot of the stuff that I've been doing recently with
valuing.
Have you ever had a dream that you want him to do you so much you could do anything?
I hope you learned something. There will be a following episode, and the episode will be